The housing market just lost 2.3 trillion in property value. This is the largest decline in percentage terms since 2008. Now, while homes were up 6.5% from a year earlier in December, that's the smallest year-over-year increase during any month since the pandemic. According to Redfin economics research lead Chen Zhao, the housing market has shed some of its value, but most homeowners will still reap big rewards from the pandemic housing boom. The total value of U.S. homes remains roughly 13 trillion higher than it was in February of 2020, the month before the pandemic was declared. Fortunately, a lot of people were left behind. Many Americans couldn't afford to buy homes even when mortgage rates hit rock bottom in 2021. And of course, this had a lot to do with the amount of competition that was in the marketplace. There was so much buyer demand, especially for the low interest rates, that many of these properties were receiving multiple offers well above ask, and it was very difficult unless you had a really strong credit position and really strong asset position to get involved in the market. When you look at this map that illustrates the year-over-year value change throughout the United States, you can see it's really a tale of east versus west. The majority of property value at this time was lost in California, with San Francisco coming in at the top spot, posting a 6.7% year-over-year decline. And then Oakland and San Jose were not far behind at just under 5%. There were only 3 other metros that saw year-over-year declines of less than 1%, which is New York, Seattle, and Boise, Idaho. However, some of these markets are still in trouble because they're only taking into account December to December. That's the year-over-year reflection. However, the peak of the market happened sometime in the spring of 2022. So as we move into the spring months, this year-over-year change is going to be a little bit more revealing, and it's likely to show some of these other markets in the West post larger and larger year-over-year declines. Some of these other areas in the Midwest and in and around Florida are holding up very strongly right now. Now, before we move on to the next slide, if you find this information useful or you enjoy hearing all of the latest stats and facts about the housing market, please consider liking and subscribing. The median existing home sales price is sitting at $359,000. This is down 13% from its peak of about $414,000. After the last housing bubble, home prices fell approximately 33% peak to trough, and that was the period from July of 2006 to January of 2012. And if we were to see the same decline today, that would only bring housing prices back to the levels we saw here in February of 2020. And if you're looking at the historical data on this chart, you can see the mania that we saw here after the pandemic started and how the real estate market jumped up approximately 40% in 2 years. Now, I'm not saying that we're going to continue to see the housing market crash from here, but one thing that I really want to point out is that it took approximately 6 years from peak to trough for the great financial crisis to fully unfold before we saw the next bull market in housing. And so housing in general, it grinds really slowly. So if we're at the start of, let's say, a bear market in housing, it may take several months or even several years to unfold completely and to see exactly where we're going to be going here moving into the future. And the other point I just want to make is that transactions occur in every market. They were taking place even through the GFC here. And you can see that there are seasonal shifts. It's extremely predictable. In the summer months, we always see prices come up, and then in the winter months, prices come down. And you can see that this happened year after year with these small peaks and valleys here that are indicated in this chart. So as we move into the spring months here in 2023, I would not be surprised if we saw housing prices pop up just a little bit. Existing U.S. home sales fell for the 12th consecutive month. This is the lowest level that we have seen since October of 2010. And this was a 37% year-over-year decline, which is actually the largest amount on record. This chart is showing the actual amount of transactions that are taking place with existing home sales. So we're currently sitting at 4 million transactions. If you were to just draw a line here and create an average, we'd probably be somewhere around 5.5 million transactions a year would be an average. But if you were to look at what would be abnormally high, I would say that it's anything over about 6 million transactions. And that's what we saw over the last couple years, as well as what we saw leading into the peak of the great financial crisis in 2005 and 2006. Now, the reduction in transactions has a lot to do with affordability. The average 30-year fix today is sitting at 6.88%. This is up about a full percentage point from what we saw a month ago. And of course, the combination of the high rates and less buyer demand, it's putting a huge strain on the real estate and mortgage industry. At the moment, purchase applications are down 18%, which puts us at the lowest level that we've seen since 1995, all the way back here. But you can see that there were other times in history when we rivaled that amount. The period between 2010 and 2014 saw a couple points in time where the purchase application volume dropped to about the level that we've seen today. Now, on a more positive note, the buyer competition is waning. So it's putting buyers more into the driver's seat in this market, which gives them the ability to negotiate a great price and great terms. The challenge they're facing in today's market, of course, is that prices are still elevated, rates are still really high, and then of course there's so low inventory still that sellers are holding really firm. So there's this standoff between buyers and sellers right now, and they're just sort of waiting to see what shakes out or what unfolds here in the coming months and years. And then of course the reduction in transactions is putting a huge strain on the real estate and mortgage industry. Wells Fargo, one of the largest lenders in the country, or at least they used to be, they just announced more layoffs for mortgage bankers. Now, if you recall, just a few short months ago, they actually laid off thousands of people in their mortgage department because they were making a strategic shift and focusing on existing customers instead of those outside of their banking system. One thing that's interesting about these recent cuts is they weren't necessarily just reducing the workforce of those who weren't performing. They actually laid off some top producers, including a few bankers who actually surpassed 100 million in loan volume last year. It's hard to imagine that a top producer bringing in over 100 million in loan origination volume would be let go from a company because they're lending primarily to people outside of their banking system. You would think that if they're able to originate outside of Wells Fargo, that it would potentially bring more business to the bank. In other words, if an originator were to be able to capture the mortgage business, there might be a higher likelihood that some of those lending customers would become clients at the bank and they'd bring their brokerage accounts there, or they'd open checking and savings accounts. But who knows? Looks like Keller Mortgage is leaving the mortgage space altogether. They're selling off their origination arm to Mutual of Omaha. And one thing that really threw me off with this one is that Keller Mortgage is affiliated with Keller Williams. So you would think that one of the largest real estate brokerages in the country would have no problem creating enough transactions or volume to be able to send referrals potentially to their mortgage company. Perhaps this company, Mutual of Omaha Mortgage, will be able to reap the benefits of the existing infrastructure that was put in place by Keller Mortgage. Now, while Keller Mortgage declined to disclose its number of employees, the NMLS shows that the Ohio-based lender has 42 branches and sponsors 110 mortgage loan originators. So this is not a small mortgage operation by any means. The shakeout here continues. According to the National Association of Realtors, members are falling for the first time in over a decade. This is somewhat typical. In bull markets, we tend to see more and more agents and more loan officers and more title companies getting involved here in the market. And then as we go into bear markets, the industry tends to shake out. People look for new jobs. People, because there's just less volume taking place, less transactions. But we saw this unfold back in 2007 and 8 as well. And you could see that the number of members declined all the way into 2011 before they started to tick back up again. And when you think about it, I mean, the average agent closes about 6 deals per year. And if transactions are down about 40%, it means that maybe the average agent might close 3 to 4. And let's just say hypothetically that the average agent commission was somewhere around $5,000 after paying all agent fees. Even if you were to close the average, let's say 4 deals a year, that would only be $20,000 per year, which would be very difficult for most people to live off of in the United States. So their income is getting hit really hard. And if transaction volumes continue at the rate that we're at today, we're likely to see this number continue to decline for the next couple of years. Now, on the positive side, for those people who are lifers in this business, so they're always going to be a real estate agent, they're always going to be a mortgage loan officer, I would say that the 80-20 rule certainly applies. There's about 20% of the agents do around 80% of the overall business. So if you're able to hang on in a market like this, as we're seeing less transactions take place, you have an opportunity to build more market share and put yourself in a position where when we start to see this big run up again or more transactions taking place, you're going to be able to reap the rewards of that activity. According to CoreLogic, U.S. single family rent price growth closed out 2022 at about half of what it was 1 year ago. While rent growth has been slowing, it still rose at more than double pre-pandemic levels. So if you look at the historical data in this chart, you can see that in most cases, rent growth tends to stay stay in this pocket right here, which is about 2 to 4% annual price growth. And of course, this chart is only dating back to 2005, but when we saw large increases in rent growth was at times where you could argue that the market was distorted. So we saw rent price growth build up into 2006, right before the GFC, where rent growth was around 6%, not nearly anything close to what we've seen today. And then we saw rent prices basically flatten out and even come down a little bit into 2009 and 2010. That's very similar, of course, to what we're seeing here today. We saw this explosion in rent growth at the peak. We saw 14% year over year increase in rent growth. And now we're starting to fall back to what we would consider more of a normal level. All right, and that's gonna wrap it up for today's video. If you found any of the information useful, I would really appreciate it if you would like, subscribe, and share the content. It really helps grow and promote the channel. Thank you so much. Take care.